But we are starting this hour with those developments, Brian, that we got out of China over the weekend. Shares of Didi really tanking in the session on the back of that. It is down well over 20%. Remember, this coming just days after the company raised about $4.4 billion in that public listing last week. Brian, we got this 1-2 punch over the weekend. On Friday, we had regulators starting cybersecurity review into Didi, blocking the company's app from accepting new users. And then you had the same regulators ordering mobile app stores to pull Didi from circulation. And it feels like this is really a quickly evolving story, given the news we got out of China this morning. The Xinhua news agency, which is, of course, the state media, reporting that China is now considering changes to its review of these companies who are listing in the U.S. with a specific focus on data security.
Well, and this is absolutely the biggest story for any Chinese company that's not only listed in the U.S., but also any sort of company that was thinking about maybe trying to raise capital here in the U.S. equities market. And we'll be talking about this at more length further on in the show. But the idea and the larger question at hand here is, are the Chinese regulators really trying to discourage some of their homegrown companies from trying to raise capital overseas, and whether or not this is just one strong arm way, if you will, of trying to get their companies, at least in their country, to list on maybe the Shanghai Stock Exchange or the Shenzhen Stock Exchange. Now, of course, this is a story that's bleeding into a number of other Chinese stocks as well. There's a number of stocks that are on the move when you take a look at Tencent, for example, moving quite a lot. And then also you want to pay attention to the stories surrounding a company known as Weibo, which is very similar to Twitter. It's kind of Chinese equivalent of that. There was a report from Reuters saying that the company's chairman had talked about the idea of maybe taking it public, supposedly in conversation with state officials as well. But the company now issuing a statement earlier this morning saying that's completely false. But you can see the stock movement on that stock, WB, shooting up on that news despite the clarification from the company. But look, this is causing waves across the Chinese equity space, and something definitely worth keeping an eye on in the months to come.
Yeah, you mentioned Weibo as one stock we're watching. Other two stocks that we're watching, the Full Truck Alliance and obviously the recruitment app Boss Jipin, which has also been sort of caught up in this regulatory scrutiny around U.S.-listed Chinese companies. And I guess for investors here in the U.S., there are a lot of questions specific to Didi, which is, did they know that this crackdown was coming when they rushed the IPO? And did Didi rush the IPO because, as the Wall Street Journal has reported, they were under pressure from some big name VCs who had backed the company, obviously looking to tap into the capital markets there. So certainly a lot of questions on that front. But I want to bring in another voice into the conversation, somebody who's quite familiar with this space, and that is Martin Chorzempa, Senior Fellow at Peterson Institute for International Economics. I'd love to have you sort of break down your analysis of what's been playing out. I mean, at the end of the day, what do you think the motivation is for the Chinese government, the regulators, to be cracking down on Didi in this way?
Thank you for having me. There is a huge amount of uncertainty in the regulation for big tech at the moment in China. We've seen a huge number of fronts on the privacy angle, cross-border data flows, financial implications of big tech in finance that led to the Jack Ma debacle and the Ant IPO being canceled. So that all is then with the political backdrop of tensions with the United States and less demand for China to need foreign capital to fund some of its major corporations. So I think we see both a backlash against Chinese firms in sensitive sectors listing abroad and an increased focus on data security. It's hard to know how much the latter is founded in real concerns because we don't really know very much about what the investigation has found thus far.
And Martin, as you point out, there are a number of question marks here, but let's take at face value the Chinese concerns about the cybersecurity of these companies. That seems to be the main reason for them throttling the Didi listing here in the United States. And I guess I'm wondering, it's not just the Didi story, though. We've seen the regulators try to crack down on just the increasing scale, as you mentioned earlier, with Ant Financial, but we've seen similar stories with Tencent and Baidu as well. So from a big tech standpoint, what does the recent news out of China tell you about not just the regulatory stance, but it's really President Xi Jinping's stance towards big tech and just the scale that they've gotten over the past couple of years?
Yeah, absolutely. For a long time, it seemed like big tech in China was pretty much immune from regulations, of course, outside of making sure to keep down any discussion that would be, politically problematic for China's leaders. The censorship side, there have been zero room for error. But in terms of scale and competition and privacy, there's been relatively limited regulation in that space. And my sense is that after Jack Ma made his speech at the Bund Summit in October, it made Chinese leaders consider that these companies could be not only problematic, but also politically some sort of threat to the regime, that they have been able to block needed regulations for many years. And once that there's been a political move to decide to crack down on these firms, there's been a flood of regulations that regulators have wanted to implement for so long, but big tech was so influential in China that the regulators weren't able to move forward. And now that the political line has shifted, they're able to just shove out all these rules in short order that's led to so much uncertainty.
Martin, I wonder if we can look at this from a geopolitical context. How much of this is really a tit for tat? I mean, it's interesting to hear the language coming out of the Chinese side, essentially being worried about data being handed over to other foreign entities like the U.S. I mean, that's sort of the same language the Trump administration used when they were talking about the issue related to TikTok. And then you've also got the PCAOB in the U.S. really cracking down on these audits, essentially saying Chinese companies need to undergo the same scrutiny as every other company that's listed in the U.S. How much of what's happening on the Chinese side is about hitting back against the U.S. on those rules?
I don't think very much of it is hitting back against the U.S. I think what's really being demonstrated here is that China doesn't really need the access to U.S. capital markets that they needed in the past to fund their innovative companies. They think they can do it on their own, and that's led them to not need to take into account so much the needs of foreign investors and the perception of foreign investors of China's regulatory environment. So even post-IPO, they can say, we don't care about that. What we care about is getting the rules that we think we need in the data protection side. And if US investors lose, that's too bad. What's interesting is that in the Ant IPO case, it was somewhat different because they decided to list in Hong Kong and Shanghai. So if the IPO would have gone forward and then regulators would have cracked down, the people that lost would have been, tens of millions of Chinese domestic retail investors. And that is more politically problematic for the regime. So I think that's also one of the differences between these two cases, is who ends up losing and how politically problematic is that for China.
Now, if we switch the perspective from the regulators to company management, at the same time, we've seen these companies decide that, yes, even though there might be this regulatory risk, if we do decide to go public in the United States, ultimately, that's the market that we want to do our capital raise in, not in China, not on the Hong Kong Stock Exchange. So do you think that the lessons learned for other companies that might be trying to go public in the future is just to, still list in the United States, but just go through all the requisite regulatory hoops, at least in their domestic market first? Or do you think that this might actually shift the needle towards really honestly directing these IPOs away from the US markets?
I think this really directs the IPOs away from the US markets, because the common denominator in all of these companies that have recently been investigated are firms that have recently listed in the United States. That sends an absolutely clear message to Chinese companies, because really, there are laws and regulations, but China is not a place that really has consistent rule of law implemented by independent courts. The laws and regulations are what the Chinese government decides they are. And there are all sorts of regimes like the cybersecurity review regime, which are essentially a black box. It's very difficult to get any sort of predictability about how these will be applied without knowing the political line. That's ultimately the most important. And now it seems clear that the political line, these rules and regulatory regimes will be enforced potentially much harder for firms that decide to list in the United States instead of in China. So I anticipate that's going to really cause firms not to want to poke the bear and list in the United States at this point.